Charlie Munger, Warren Buffett's right-hand man, is widely regarded as an investment legend. Since 1986, he's beaten the market by over 2,000% with the Daily Journal portfolio. Munger recently addressed the critical difficulties in the economy and financial markets at the Daily Journal's annual conference. This video will demonstrate how Munger is structuring his portfolio to outperform the market significantly over the next few years. Welcome to Empire Investing, where we'll be sharing the latest in stock market news, technology, and innovative investment strategies for aspiring millionaires and billionaires. If this is your first time watching our channel, please do consider subscribing to see more videos just like this, and let's get started. To understand how Munger intends to generate significant amounts of income from the economy, we must first examine the macroeconomic climate. As a result of COVID-19, the federal government was forced to step in to give assistance as consumer spending came to a standstill. Unemployment is classified into two types. U3 unemployment keeps track of all jobless persons who are actively seeking work. U6 unemployment is a more comprehensive metric that includes discouraged employees and part-time workers. In April of 2020, U3 unemployment surpassed 14%, while U6 unemployment surpassed 22%. That's a significant sum given that nearly 1 out of every 4 persons was jobless or underemployed. As a result, Congress sent stimulus checks to citizens and gave different loan and grant opportunities to state and local governments. These checks also contained COVID relief payments, which aided companies. On the monetary front, the Federal Reserve reduced interest rates, which made borrowing less expensive. The target interest rate fell from around 1.5% at the end of February 2020 to approximately 0.06% in April of 2020. That rate is now 0.08%, but it is likely to rise. These measures, as we'll see shortly, are laying the groundwork for a horrific economic collapse. While the Federal Reserve cut interest rates, it increased its purchases of government bonds in the market, often known as quantitative easing. Ever since the pandemic began, the Federal Reserve had acquired over $4 trillion in debt, which pushed money into the economy. M2 is a measure of money in the economy that includes cash on hand, savings accounts, money market accounts, and certificates of deposit worth less than $100,000. Inflation was brought about by the law of supply and demand. More money accessible to everyone increased demand for commodities, but this alone did not cause the inflation we are witnessing today. Munger is acutely aware of the rise in M2 money, inflation, and the consequences, an asset bubble. The challenges associated with the supply chain have significantly exacerbated the situation. You've certainly noticed a lack of things in stores as well as prices rises on items such as electronic devices. The majority of this is due to the inability to get things off ships and into the market. The fundamental flaws began before COVID but were accelerated by the epidemic. The underlying concerns are numerous. To begin with, there is a restricted capacity for ship offloading and a shortage of chassis to extend that capacity. Due to a lack of salary increases, the number of truckers permitted to operate at ports has also decreased. The situation was compounded further by the United States' warehousing technology, which lags behind that of Japan, Korea, and China. Similarly, warehouse worker compensation has not always kept pace, and hiring skilled warehouse employees has become more difficult. The scarcity of warehouse staff has also hampered supply lines. An experienced truck driver, Ryan Johnson, posted a popular thread detailing some of the challenges from his perspective. He compares the present supply difficulties to a business with one cashier for hundreds of customers, such as Costco or Walmart. Truckers like him must wait in 3 distinct queues for many hours before picking up a container to take it across the nation. Goldman Sachs and a few other financial companies monitor the supply chain. Goldman just reduced the stress level to 9 out of 10, with 10 being the maximum level of stress. According to the Marine Exchange of Southern California and Goldman Sachs, the number of boats waiting to discharge commodities at the Los Angeles port dropped down to 89 from its high above 100. When you consider there were no vessels 20 months ago, that is a big number. That may seem terrifying, but there may be hope. The timeline for resolving this economic challenge varies, but it appears to be closer to the end of 2022 to the middle of 2023. The main point here is that all of this pressure effectively results in a shortage of supply of goods. This pressure, along with a rise in the money supply, has driven up consumer costs to record highs. The Consumer Price Index has increased to a 7.5% annual increase. Inflation and interest rates are related, which is a crucial concept to understand. Inflation reached previously unheard of levels throughout the 1980s. Fed Chairman Paul Volcker hiked interest rates many times in order to stay ahead of inflation. While the outcome was positive for the economy as a whole, raising interest rates is often not a popular measure politically. Even though the Fed is meant to be above political influence, Charlie Munger believes it's not very likely that someone like Paul Volcker will be able to raise rates in today's political atmosphere. He also stated that this might lead to new problems that are worse than those seen in the late 1970s and early 1980s. In the late 1970s and early 1980s, those were awful years to invest in the market. When adjusted for inflation, the market returned 0% from 1965 to 1980. Munger predicts a similar scenario, and the market may potentially lose money during the following decade. In the DJCO annual meeting, Munger said, "If you try and print too much money, it eventually causes terrible trouble. And we are closer to terrible trouble than we've been in the past, but it may still be a long way off. I certainly hope so." The first consequence we explored was a decade of high and low inflation-adjusted stock market returns. There's also the chance of a second conclusion, which worries Munger a lot more. The Fed has made it clear that it does not want a repeat of the 1970s, and it has already indicated that interest rates will be hiked. CME Group, the world's largest futures exchange, has published data on market expectations and how effectively investors forecast interest rate increases. Currently, 4 to 6 Fed rate rises are expected in 2022, followed by 2 to 3 more in 2023. Normally, these increases are 25 basis points in size. 1 basis point is equal to 0.01%. A 25 basis point increase equals a 0.25% increase. Thus, a 25 basis point increase from 2% results in a rate of 2.25%. The target interest rate is expected to wind up at 1.625%, up from 0.08% today. In addition to raising interest rates, the Fed is cutting asset purchases, notably Treasury bonds, often known as treasuries. This has the effect of reducing the available supply of money. In January of 2022, the Fed lowered purchases to $60 billion, a $30 billion decrease from December and a $60 billion decrease from November. It is worth noting that the Fed is still buying bonds, which boosts the quantity of money in the economy and generates an artificial demand for treasuries. As the Fed decreases its purchases to crucial price and yield levels, there must be an equal amount of new demand stepping in. This increased demand would have to compensate for the Fed's lack of bond purchases. To have a net zero influence on the market, treasuries would need to find outside investors who would add $60 to $100 billion to their portfolios each month. That is highly unlikely. As a result, the tapering will result in reduced bond prices. Bond rates and bond prices are inversely connected, therefore greater U.S. Treasury yields would result. While the media concentrates on the Fed raising interest rates, the tapering of bonds will have a significant influence on bond yields and hence interest rates. Charlie Munger is cautious to predict that the low interest rate asset bubble would burst when interest rates rise. He feels the reduced prices were implemented as a last resort during the COVID outbreak. The United States is on the verge of a disaster if we continue to have low interest rates and rising inflation, especially now that we have passed COVID. Let's listen to what Munger said during an interview where he was asked about the conventional economic theory that argues excessive monetary and fiscal stimulus over the last 2 years has triggered the highest inflation in 40 years. Well, the first part, I agree. I agree with it. We've done something, but we've done something pretty extreme and we don't know how bad the troubles will be. Whether we're going to be like Japan or something a lot worse. And what makes life interesting is we don't know how it's going to work out. I think we do know we're flirting with serious trouble. I think we also know that some of our earlier fears were overblown. Charlie Munger. So now that we know the economy is in bad shape, what should investors do? Munger is cautious on office real estate, but he advocates investing in apartment building firms. The Mungers have Berkshire stock, Costco stock, Chinese stocks through Lilu, a little bit of Daily Journal stock, and a bunch of apartment houses. Do I think that's perfect? No. Do I think it's okay? Yes. I think the great lesson from the Mungers is you don't need all this damn diversification. That's plenty of. You're lucky if you've got 4 good assets. I think the finance professors and that sell the idea that perfect diversification is professional investment. If you're trying to do better than the average, you're lucky if you have 4 things to buy, and to ask for 20 is really asking for egg in your beer. It's very few people have enough brains to get 20 good investments. Charlie Munger. Munger contends that diversification beyond 4 to 6 assets is not a smart idea, contrary to most financial expert advice in business schools. While he does not provide an exact figure, he does claim that increasing diversification too much has decreasing returns. His thesis is well grounded in Markowitz's modern portfolio theory, abbreviated MMT. According to this hypothesis, acquiring a stock lowers portfolio volatility, and when additional stocks are added, the fluctuations get smaller and fewer. However, in the past, this trade-off has not been one-to-one, as each individual investment has a decreasing influence on the portfolio. This, of course, presupposes that each investment is proportionally equal to the others. With 10 stocks, each one would account for 10% of the portfolio. With 5 stocks, each stock is worth 20%, and with 100 stocks, each stock is worth 1%. As one would imagine, doubling one stock makes little difference when there are 100 stocks. However, doubling one stock has a far higher impact when there are 5 stocks. Munger also alluded to the great short squeeze and excessive multiple values. Based on Bloomberg estimates of consensus earnings, the S&P 500 is now trading at a forward PE of 20. While this is down from the previous peak of 27 times in August of 2021, this level of frothiness has not been witnessed in the last 20 years. Similarly, the Nasdaq has dropped to a PE ratio of 28 times Bloomberg consensus, down from a high of 40 times in December. These figures haven't been seen since 2003. Given the current macroeconomic circumstances, diversification outside of the United States might be beneficial. Munger has also made investments in China through companies like BYD and Alibaba. BYD has been one of Munger's finest investments of all time, leading to his more recent investment in Alibaba. In both this year's and last year's interviews, he explained why he chose to invest in China despite the significant dangers. There are several inherent dangers to investing in China, as I'm sure many of you are aware from recent headlines. However, Charlie Munger feels that while these dangers exist, including regulatory, economic, and delisting issues, the value in China's financial sector is far higher than that in the United States. Munger said, "Well, we did it for a very simple reason. We got more strength per dollar invested. In China, the companies we invest in are stronger relative to their competition and priced lower. That's why we're in China." Munger went on to say that China and the United States have severe tensions and that this would continue since the United States does not appear to realize that the differences in government are appropriate. While China's system and policies would not have worked in the United States, they were necessary for China. Along with Munger, several other renowned investors have continued to invest in China. These include Ray Dalio, Sequoia Capital, and Monish Pabrai. Munger believes that the two nations, the United States and China, would maintain stable ties with reasonable honor, lowering the danger. Munger's presentation serves as a backdrop for his ideas. Higher inflation, Fed tightening, supply chain difficulties, and stretched valuations and speculation have put the markets in jeopardy. Munger's portfolio has been managed to withstand these macroeconomic shifts by allocating capital to strong firms. His portfolio mainly is comprised of 5 firms: Bank of America, Wells Fargo, Alibaba, US Bank, and POSCO, a South Korean firm. Munger is not a lover of diversity, thus he has picked these 3 firms as his long-term winners. That's all for today. Do you agree with Munger? Join the discussion in the comments below. And if you like the video, please click the like and subscribe button too. We'll see you guys in the next video.